Hello and welcome to the Roundup. We'll be covering all that was important to accountants and advisors across the month of October. This month, we're looking at the introduction of director IDs and the particular problem for foreign directors. We'll also look at the loss carryback offset and franking accounts and some of the problems applying the rules in practice. But first up, Michael's going to take you through the latest from the ATO on cryptocurrency.
As many of us would be aware, the whole area of cryptocurrency and similar technologies is a really fast developing and emerging area. And probably to be expected that ATO guidance in this area sometimes lags a little bit behind what's actually happening out there in the real world. But the ATO does publish some guidance in this area. We've seen some specific guides and formal documents from the ATO in relation to the tax treatment of cryptocurrency over the years. And in the last month or so, the ATO has released another guide in this area. And this guide is quite specifically aimed at tax practitioners. Now, it's quite a brief guide, but there are some interesting points that come out of that guide, which I thought it might be worth just giving a bit of an update on. The first thing is that the ATO makes a really interesting comment that they seem to take the view that most people will be holding cryptocurrency as an investment and therefore on capital account. The ATO says quite briefly again that most people would be holding cryptocurrency with a view of making a capital gain over the longer term. Now, I'm not quite sure about that comment, and I'm not quite sure where that comes from or why the ATO would make a statement along those lines. I assume it's because they've kind of looked at a number of cases and situations where people have had transactions involving cryptocurrency and have reached the view that more often than not, they're dealing with a capital account treatment. But just be a little bit careful about that because it is really something that depends on the client's circumstances. We do need to delve into detail in order to determine whether our clients might be carrying on a business involving cryptocurrency, whether that's a mining business or a trading business, whatever the case may be. And there may well be situations where clients are not carrying on a business activity as such, but their activities are still dealt with on revenue account on the basis that they're involved in a profit-making undertaking. So I think that's the first thing. I mean, have a look at the ATO's comments on that. As I said, they're pretty brief, but just be a little bit careful about really placing too much reliance on that because it is so heavily driven by a client's specific circumstances. Now, when it comes to clients who do hold cryptocurrency on capital account, again, the ATO makes some interesting points. Some of them are probably common sense for some people. But one of the key things that does come up over and over again, and practitioners are asking about this quite often, is what happens when clients exchange one type of cryptocurrency for another type of cryptocurrency. And the short answer to that, at this stage anyway, is that is something that would trigger a taxing event, whether that item is held on capital or revenue account. So if a client disposes of one type of cryptocurrency and doesn't receive cash, Australian dollars in return, that doesn't mean there isn't a taxing event. There's still a CGT event because they have disposed of a CGT asset and have received something else in return. So we're dealing with two different assets. So we do need to recognise that there is generally going to be a taxing event there. We'll need to determine whether a gain or loss needs to be recognised from a tax point of view. But on the other side of things, moving items of cryptocurrency, coins from one wallet to another won't generally trigger a taxing event as long as there is no change in the underlying ownership of those items. And we see that happen in other cases, for example, involving shares. You might have clients who are moving shares from, say, a provider of a wrap account, etc. And really what we need to do is look at whether there is a change in ownership of those shares or not. What does the client actually own? And is there a disposal or reacquisition of assets? And if not, well, we generally won't be dealing with a taxing event. Probably just the final point to make there is if we do reach the conclusion that clients are carrying on a business of trading or mining cryptocurrency, just remember you need to work through the trading stock rules. So that means generally we'll be claiming deductions for lots of things up front. We'll be recognising sale proceeds on revenue account as sales are made. But the other thing just remember is trading stock rules, we need to pick up movements in the closing value of stock from year to year. And that's the bit that's a bit easy to forget when we're dealing with something that is a little bit outside the ordinary when it comes to trading stock. So we do have a little bit more guidance from the ATO in this area. Look, I've got to say that there's a whole bunch of issues that are not currently dealt with, from what I can see anyway, in any sort of public ATO guidance. But we hope that that changes, and you would expect that that would change over time as the ATO has time to kind of consider its views on some of these issues. So it's still an area to be very careful about. Take a look at the ATO's latest guide. It kind of sets out some of the questions you would be expected to ask of your clients to figure out tax treatment for them. And again, it's another reference point that we can go to in this fast developing area.
In September, the ATO participated in Knowledge Shop's cryptocurrency forum. The ATO has since followed up on some of these questions from participants at that forum, and you can read these on Knowledge Shop's blog. Now it's across to Matthew to look at the introduction of director IDs.
Now, what's been getting some traction lately is director IDs. So from this month onwards, the process is now open for company directors to verify their identity and to obtain a 15-digit director ID with the Australian Business Registry. Now, the overall idea behind this director ID is just to have something on hand that helps trace directors over time, help with identifying fraudulent director identities, and basically assist authorities with identifying directors who have been involved in some illegal activity. Basically, the director ID requirements apply to directors or alternate directors of Corps Act companies, registered Australian bodies, or even foreign companies that are registered with ASIC. Now, it's just important to remember, if you're dealing with a trust that has a corporate trustee, there's a company there, and directors of those companies are covered also. In terms of process, the easiest way of verifying the director's identity and obtaining that director ID is probably through the Australian Business Registry website, so online. The director will need a MyGov account and have some documents on hand just to verify who they are. So that can include bank account details or a notice of assessment. Once the director has these documents on hand, the Australian Business Registry actually thinks the entire process should take less than 5 minutes. Now, for an overseas-based director, the process is much more involved. The application is a paper application sent through mail. They'll need certified copies of 2 identity documents, which are set out from a prescribed list. Those documents then need to be certified, and only by certain people, which include notary publics and staff at an Australian embassy. For some of us, you might be familiar with this certification process if you've ever had to look into a TFN application for a non-resident. Now, because I know you're probably going to get this question, the Business Registry does make it quite clear that tax agents shouldn't be applying for these things on behalf of the director. Now, turning to when the director ID needs to be all sorted by, it really depends on when the director commenced. For most new directors that commence from the 1st of November 2021 to the 4th of April 2022, they've basically got 28 days from appointment to get this all sorted. From the 4th of April 2022 onwards, it does become a bit more strict, and they'll need to go through this process before they are appointed. Now, the good news is for existing directors commencing before the 1st of November 2021, they've got until the 30th of November 2022, so basically a year or so. Look, whilst they've got some time, I think ultimately the key message here is that it's still probably a good idea to start having those conversations with clients that are existing directors and bring their director ID obligations at least to their attention. With directors commencing from the 1st of November 2021, that discussion becomes a bit more urgent because the timelines are actually much more tighter.
For Knowledge Shop members, the Director ID issue is covered in greater detail in the download of the Roundup and also in this month's Your Knowledge client newsletter. Now it's across to Michael for the latest on the lost carryback offset.
Many practitioners would have started to refer to and utilise the lost carryback rules for some of their company clients over the last few months. And while some aspects of those rules are relatively straightforward, there are certain aspects of those rules that are tending to cause quite a few problems in practice. And the issue that we're focusing on at the moment is the franking account balance issue. And the ATO has released some guidance on this quite recently, and really just encouraging people to be very careful about how they go about calculating and verifying franking account balances for companies. Now, the reason why this is such an important issue is that your entitlement to a loss carryback offset, which can be a refundable offset and can potentially give rise to a cash refund for companies who've paid tax in the past, that offset is capped at the company's franking account balance at the end of the relevant income year when it is applying the tax offset in its tax return, basically. So even though we might have worked through a calculation process and an eligibility process to determine whether the company is able to claim that tax offset and what the offset might be, we always need to then overlay the franking account balance. For example, if our franking account balance at the end of that relevant year is nil, then the tax offset will be nil and there won't be any cash refund coming to the company under those rules. Now, one of the issues that's come up quite a bit, and we've seen a few examples of this over the last few months, is the situation where a company may have lodged prior year tax returns but has outstanding tax liabilities. So an assessment has been issued, it's been created, but that tax liability or some of that tax liability from a previous year hasn't actually been paid yet by the company. Now, while the loss carryback tax offset rules are really aimed only at companies that are up to date with their tax return lodgements, there's a specific condition around that. There doesn't seem to be anything that says you can't access the loss carryback offset just because you have some outstanding tax debts, even if they're income tax debts. However, the practical issue there is that if a company has some outstanding income tax liabilities, then that could have a material impact on its franking account balance and the amount that it could then claim under the loss carryback tax offset rules. And in some cases, we've seen situations where a company's franking account balance is nil, which means that the tax offset would be nil. But had the company paid its income tax liabilities earlier, then it could have been able to claim a significant tax offset. So that is an issue that we need to be very careful about. As I said, we're seeing that come up a little bit in practice. The other thing is that the ATO guide in this area that's come out recently is really focusing on the sorts of things that we would look at as we're reviewing a client's franking account balance. Look, to some extent, sometimes you see franking account balances appear on tax returns and maybe no one has really turned a whole lot of attention on whether that franking balance is correct or not. I suspect that when we've got companies claiming loss carryback tax offsets, particularly significant amounts, that is an area where the ATO will probably end up doing a bit of review work, actually going back and checking that that franking account balance is accurate. So to what extent has someone actually looked at that? To what extent have those balances been checked year on year? If you're not confident that that's been done, then really now's the time to do that before lodging the return and claiming that offset. Checking if and when income tax and PAYG installment payments have been made, checking when refunds have been received, checking the receipt and payment of franked dividends, and double checking that all those relevant entries have been captured in the franking account. Another issue that comes up a bit from time to time is companies that have obtained a refund under the R&D tax incentive. Normally, those refunds generate deferred franking debits that don't necessarily have a direct impact on the franking account balance, but they potentially have an indirect impact because future tax payments get allocated against those deferred debits first before being added to the franking account balance. So there's quite a number of issues that can come up as we're looking at whether a franking account balance is accurate or not. So it's certainly an area to be quite careful about when you're looking at clients who are looking to claim that tax offset. And as I said, I suspect this is an area that the ATO will end up doing a bit of review work on. So good to be proactive on it and kind of get ahead of things and make sure that you're confident on that number before the ATO decides to have a look at it.
And that's the roundup for this month. If you need to pass the FASERA exam in November and need support, Knowledge Shop's on-demand exam prep is there to help. It's training you can do at any time and from anywhere. Have a look at the Knowledge Shop website for more details or give the team a call and they'll be happy to talk you through it. We'll look forward to seeing you next month.